Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On tonight's program, I've secured the inside answers from a very, very good small caps fund manager in the name of Ben Griffiths from a company called Eli Griffiths. I've been arguing for a long time that small caps were likely to do well in 2024 as soon as interest rates start coming down. So I wanted to talk to Ben, and Ben's going to tell us whether he agrees with me and what companies he likes for 2024 and beyond. And then Paul Rickard will join us, and Paul will be talking about what stocks he thinks are going to do well in 2024. Now remember, only the first part of our show is open for everyone to see. The second part of the show is only for subscribers to the Switzer Report. So let's kick off now with Ben Griffiths from Eli Griffiths. Thanks for joining us, Ben.
Pleasure, Peter.
I wanted to get you on because I've been arguing that eventually when interest rates come down, small caps and tech companies and growth companies will get re-loved, because particularly small caps, they've been on the outer for quite some time.
Yeah.
What is the history of small caps and rising interest rates and then falling interest rates?
Yeah, well, it's a particularly apt question. It's timely. You're not the only one also, Peter, by the way, that's been asking and trying to piece it all together, because it's timely. And small caps globally have been, if you will, on the nose. They've been neglected. They haven't been the flavour of the month for a while. But why don't we have a look at that chart and let's have a look at...
Okay. So what are we looking at here?
So what we're looking at here, on the left-hand side, Peter, we have a relative strength chart, which is the small companies versus the large caps.
Yep.
And as that chart there, as you can see, it's been pretty desultory. It's trading downwards pretty hard, and it started trading down from late 2021. And that, as you'll recall, was about the time when the rumbling started on we're going to see higher interest rates.
Yep, exactly.
Interest rates are coming. It started in the US, and it wasn't long before the tom-toms were sounding here.
Yep.
So we're seeing that phenomena there, which of course the connection with interest rates, of course, is the high levels of economic cyclicality that small companies are exposed to. Means we don't really want to see a high interest rate environment for small companies. They're at the pointy end of the exposures.
Yeah, and I know today on my report with Ben Ford and 12GB, that NAB survey talked about how people are stopping their spending, especially younger people at the moment, because they've been slugged by interest rates. So less on entertainment, less on cafes, less on even having food sent to their homes.
Yep.
Yeah, they're making it so small companies that actually deal with all these people feel the pinch.
Correct. They're at the forefront of the economic multiplier, the effect that comes through.
Yeah.
So that chart on the left highlights the movement, the flight of capital away from small companies in favour of large caps.
Yep.
And that trend started, of course, as I said, in late 21 when the tom-tom started, and that has continued through 22 and then through 23 as well. The first hike in interest rates happened with the Fed in March 22. And in Australia, the RBA moved on rates in about May 22.
Yep, exactly.
You can see the pressure there. Now, what we're seeing now is a stabilisation in that underperformance by small caps, as expectations mount that in fact we've seen the last of the rate hikes. The chart on the right is expressing that correlation, or that link. The grey line, of course, to your earlier reference point, is the US interest rates, and we'll call it, this is the US 2-year bond, starting back at that reference point at 21, and you can see progressively from almost 0% interest rates right the way through to about 5% at the moment. Concurrent with that, we've got the relative performance, which has been miserable with the small orders cutting across, and you can see the correlation, according to our quant analyst in the office, is about almost perfect. Interest rates and small cap movements. And what we've seen of late, of course, pretty well from November 1 last year, was a change in rhetoric from the Fed. Right, and bearing in mind, of course, that the Fed leads the world's interest rate settings, that perhaps enough has been done, that they're curbing inflation, and that central bank accommodation, easier interest rates, are not far away.
So, Ben, this is when we were really scared and crapping ourselves with rising interest rates.
Yes.
As the talk became less and less aggressive about interest rates.
Correct.
That started levelling off, and you can see that there as well.
Correct.
As interest rates flattened out, the fear factor and the interest in buying small cap started to rise.
Correct, and hence the interest levels generally, and it's not just an Australian phenomenon where astute advisors and observers like you are asking the question. This is a global thing. It's a discussion that's now visiting the Russell 2000 in the US, and several small cap and mid cap indices in Europe are also coming under focus as being good hunting, good buying.
Yeah, and I guess from your point of view, and we should explain, Ely Griffiths is a company with a number of funds, and one of the funds is, what's the name of your small
It's the Ely Griffiths Group Small Companies Fund.
Yeah.
We have three funds in the family: the mid cap fund and and of course the emerging company or micro cap fund.
Yeah. Okay.
So we deal in that part of the market. So we're particularly sensitive to what will move sentiment, what will move interest in these stocks.
Okay. So how did last year go? And you have already alluded to a little bit of last year.
Yeah.
And what you maybe saw in the last quarter of last year.
Yeah.
Is that a bit of a sneak preview of what we should expect in 2024?
Well, what we've seen is we saw the first reaction, the first sentiment change. And when you get a sentiment change, you get the early professional money starts to moderate its positioning. You get positioning change. So sentiment then quickly leads into people following with their money. And we saw short covering across the US market as people who were short small caps, and Russell 2000 is predominantly where that happens. We saw short covering rallies aggressively covering short positions and putting long positions in place. So that's the typical evolution of people who are bearish and negative on a stock or a sector or a market. Is the short positions are in place, they make lots of money, they then realise the short trade is running out of steam, and then you start to see the positioning go the other way. And we started to see that into November and into December. The next stage, of course, is when you get fundamental recognition that rates are going down and that the US, for instance, the world might skirt a recession. We might come out with some growth slowing but no recession. That then brings in what we call the long side buying, where people start to actually not just cover shorts, but actually put hard dollars down and take a positive exposure to stocks.
Yeah, and as I was listening to you, my mind went back to probably 2015 and to 18, when unknown companies like Afterpay and Zip and Tyro and all those sorts of companies were small cap companies then, and they became increasingly more sought after. Interest rates were ridiculously low. It was easy for those sorts of companies. So do we envisage then that a lot of companies that have been really on the nose for the last 2 or 3 years, and I must admit one of the companies was EML, who last week all of a sudden had a big spike. That's a company that's had lots of problems apart from interest rate problems, but do a lot of those sort of worries get forgotten about once interest rates start to fall, as long as the company's not going bad?
Totally, because confidence returns and people's behaviours change and people's risk appetites start to improve, and then people start to think it might be safe to go in. A couple of things I've seen, and let me share them with you, Peter, a couple of things I've observed in the last 3 months that make me think that the worst is behind us. And the first thing is we just had a series of annual general meetings held from October, November into early December.
Right.
And the general takeaway was there was anxieties coming into that period, into that season. The end result was most small companies on balance reported pretty good updates. They advised that trading wasn't so bad. So all of a sudden there were fewer downgrades. In fact, there were probably more upgrades than downgrades in the wash-up. So all of a sudden investors who were getting very bearish suddenly thought maybe it isn't too bad out there, maybe things have turned. We've also seen post the last reporting season that small company balance sheets are in pretty good shape. So even though they've had to wear a higher interest rate burden, they've actually been in a better debt position. So balance sheets are pretty good. In the last 3 months of the year, we saw something like $1.7 billion raised in new equity placements and rights issues and the like. 12 months ago, you couldn't have raised much money at all. 1.7 billion was raised very easily in the quarter, and we had about 600 million of founder sell downs, where founders who've been sitting on nice positions decide to sell a bit of stock personally and take some money off the table. Again, 600 million of those sorts of transactions were not doable too long ago, and they were in fact happened. And the final piece that made me feel a little more confident, and certainly has created a restoration of animal spirits, was we've had the return of the takeover. In the last quarter, we've had 10 takeover bids launched in our space, and they've been predominantly from international suitors. So that tells me that not only are domestic investors getting excited, they're writing out cheques for new share placements, but you're getting corporates, both local and in particular international corporates, are saying, you know what, valuations are about right, the conditions aren't so bad, we might buy some of these businesses that appear to have been on sale. So there's a checklist there that I've seen, and I've gone, hang on, but maybe the improving spirits are based on more than just a hunch and a bit of mean reversion. There's a more fundamental thing at play.
And you're making me ask this question, and we know anything we say here is not advice, it's just educational, historical observation of what people like us have learned over the years. Some people out there who really might have been cheesed off holding a company that's really disappointed for 2 or 3 years, sometime this year, those companies might get offers for takeovers, or the lower interest rates might change the outlook for these companies. Some people might pay them to be a little bit more tolerant for at least 1 more year. Yeah.
Well, as you say, can't give advice.
No.
But absolutely, this is the typical.
Because you'd be trawling around for the companies that you want to go along and who may well be exposed to that.
Correct. Yeah. So, and that is how the cycle has played out. Right. Not just this time. It's how it plays out almost every other cycle. Valuations become ridiculously stretched on the downside. Funding gets a bit cheaper for corporates to make the move. Corporates are sitting on cash, but it's that magical element that is missing, and that's confidence. And all of a sudden, corporates get their confidence back. Personal investors, private investors, the household sector gets its confidence back. They start spending, and the cycle starts again.
Yeah.
So I think we're seeing the beginning of another cycle.
Okay. Well, Ben, I never get you to come on my shows and not make you pay.
Ah, yes.
Okay. Yeah. Give us a couple of companies that you really think, you may well already have exposure to them, but you think they're going to do really well.
Yes.
Why don't you give us a couple of companies that you think really look interesting?
A couple of companies that Ely Griffiths Group is very fond of. It would be Pinnacle Investment Management, which of course is an owner and supporter of boutique funds managers, and they are a very astute operators and who've supported a number of boutiques and
have a lot of fund managers suffered, and therefore they will maybe over-smashed and could make a comeback over the next year.
They're a direct beneficiary of an improving stock market. So front and centre, why Pinnacle makes a lot of sense, has made sense to us. Look, we're believers in Ridley Corporation, Ridley being the agricultural food supplements business.
Yeah. And is there a product that we should know that they do?
Well, not particularly. It's more related to the ag sector, where they provide food meals and bulk stock foods.
Okay.
So I guess
the factories that make other products might use it.
Yes,
use them. Okay.
Correct. So there might be fish meal that the salmon industry uses to feed fish, and you'll have cattle licks and sheep licks for food supplements. Yeah. So we're very fond of Ridley.
Is it exposed to drought and flood and stuff like that? A company like that?
Yes, it is. But the business has done a great job of diversifying away from being just reliant on drought, benefiting from drought, or being at risk during floods. So the business has done a great job of diversifying, and it's a very well managed business. Yeah. And the last stock I'll leave you with, of course, is one that many of your listeners and viewers will be familiar with. That's Lovisa. And Lovisa, of course, is rolling out costume jewellery. They're a very accomplished and successful retailer.
Yeah. They've had some fantastic runs. Were they a classic casualty of being small cap and on the outer because of either debt or high interest rates?
Totally. They were shunned. They were seen as somewhat of a racy growth story that's rolling out the Lovisa footprint across every continent and every country within every continent, and was seen as being clearly very much in the crosshairs if we get an economic slowdown and the consumer goes on strike. Even costume jewellery sales will fall. And so therein, if that's the thinking and the share price gets knocked around, therein is the setup really for investors who've got a longer term perspective, who can see that there's a genuine rollout story there.
Yeah.
So we like Lavisa, we like Ridley, and of course we like Pinnacle as a couple of great stories.
Yeah,
for
and
portfolios.
how many small caps would you have in your fund?
Yeah, well, in a typical fund, we might have anywhere between 35 to 55. So on average, it might be sort of 45, 46 per portfolio.
Yep.
So we need to be concentrated with our positions. We need to be having conviction. Same time, we need to use the attributes of diversification to manage risk. So that's how we approach portfolio selection. And then the ongoing process, as you'd expect, of risk management, making sure that we're not too exposed to stories.
Okay, one final question. I always try to think, well, if someone's listening to this, they want to know the answer to this question. You've been on the outer since 21, 2024 looks good. Yes. How many years do you expect to get the positive momentum of lower interest rates helping these businesses?
Yeah, well, that's a very, very difficult question.
Oh, come on, don't try and run away from a hard question, mate.
And if I definitely had the answer, I'd perhaps be holed up in Monaco right now. But I think, Peter, what you need to think about is the market cycle is a little different to the economic cycle. The market cycle tends to preempt what goes on in the real world. The stock market has started its rally, it's commenced its rally in anticipation of good times ahead. We're seeing the beginnings of the economic signalling, that things are getting a bit better and confidence is coming back. We know that there's a bit of accommodation to be handed out by central banks. Remember, interest rates were, in the US, they were basically zero, and the current Fed funds rate's 5.5%. So there's 550 basis points potentially of available accommodation. The Fed won't be in a rush to hand that back. So I think the whole accommodation easing cycle could take a number of years. They won't be in a rush to do it. Whilst that is happening, and whilst there's the spectre that rates will be going lower, that's enough to keep investors engaged. So remembering the market's moving ahead, it's anticipating. It then gets backfilled with real world data. There's several years of this expansion on, and then the market we then should expect, as you'd know, that the market then goes the other way and it overreaches. Yeah. And small caps start to trade at a big premium to the rest of the market. Yeah. And then you'll know, well, hang on, it's all gone too far the other way now. Now that's a long way from happening. In the United States, the Russell 2000 used to trade at a very handy premium, substantial premium to the S&P 500 and the S&P 100. Today the Russell 2000 is at a discount. Yeah. So there's a big, not only will we see earnings revive, we would expect to see the P rating revive. So that takes years to play out. Yeah.
So in the absence of something crazy happening either via Beijing or Washington with Donald Trump as president, if we rule all those sort of things out and the Middle East and Ukraine things don't become much bigger than we're currently expecting, we've probably got a couple of years at least of small caps doing pretty well.
Yeah, that'd be my state. That'd be my guess. Yeah. Is the market cycle has a long way to run.
Yeah. And 2 years is not a long one, so we're being conservative by saying 2024, 2025.
Well, I think so.
Yeah, me too. That's Ben Griffiths from LA Griffiths. And that's the show for tonight. Thanks for joining us. Remember, if you want to see the full show, you are going to have to be a subscriber. And I hope you do that as soon as possible. Thanks for joining us. See you next week.